Bitcoin from Scratch, Understanding the Digital Revolution, Episode 9, Bitcoin as a Store of Value. In this episode, we will analyze the role of Bitcoin as an investment asset, comparing it to gold and other traditional stores of value. We will evaluate its capacity to preserve value over the long term and its behavior in the financial market. By exploring the unique characteristics of Bitcoin and understanding how it stacks up against conventional assets, viewers will gain insights into why Bitcoin is often referred to as digital gold. We will also look at the broader macroeconomic implications of using Bitcoin as a store of value and the potential impact on global finance. Bitcoin as an investment asset. Bitcoin has gained recognition as a form of digital gold due to its limited supply and resistance to censorship. Its maximum supply is capped at 21 million coins, giving it a characteristic of scarcity similar to that of precious metals. This digital scarcity has led some investors to consider Bitcoin an attractive store of value, especially in an era of increasing money supply and currency devaluation. Bitcoin operates on a decentralized network, which means that no central authority can manipulate its supply, making it an appealing alternative for those looking to hedge against inflation and currency instability. Unlike traditional assets, Bitcoin also offers a high level of transparency, as all transactions are recorded on a public blockchain, providing greater accountability and trust in its value. The decentralized nature of Bitcoin adds to its appeal as an investment asset, particularly in regions where financial systems are unreliable or vulnerable to government interference. Bitcoin's ability to facilitate peer-to-peer transactions without the need for intermediaries has made it an effective way for people to store and transfer value securely. Additionally, Bitcoin's performance over the past decade has attracted institutional investors who view it as a new asset class that offers diversification benefits. As more financial institutions and corporations add Bitcoin to their balance sheets, its role as a long-term investment is being further solidified. The entry of major financial players, such as investment banks and hedge funds, has brought increased legitimacy and stability to Bitcoin, helping it transition from a niche asset to a mainstream investment option. Another key factor that makes Bitcoin attractive as an investment asset is its ability to function as a hedge against macroeconomic instability. Unlike fiat currencies, which are subject to inflationary pressures due to government policies and central bank actions, Bitcoin's supply remains fixed. This characteristic makes it an attractive option for investors who are looking for an asset that can maintain its value in the face of economic uncertainty and rising inflation. Bitcoin's programmability and integration with smart contracts also open up opportunities for innovative financial products, such as decentralized finance, DeFi applications, which add additional utility to the asset. DeFi platforms enable users to lend, borrow, and earn interest on their Bitcoin holdings, further enhancing its value proposition as a versatile and productive investment. Bitcoin's appeal as an investment is also driven by its global accessibility. Unlike traditional investment assets, which may require investors to go through brokers or financial institutions, Bitcoin can be acquired and held by anyone with an internet connection. This democratization of access makes Bitcoin particularly attractive to those in countries with limited banking infrastructure or restrictive financial policies. Bitcoin also provides a level of financial sovereignty that is not possible with traditional investments, as it allows individuals to store and control their wealth without the need for third-party custodians. This ability to bypass traditional financial gatekeepers has contributed to Bitcoin's growing popularity among investors who value privacy and autonomy. Comparison with gold and other stores of value. Durability. Both gold and Bitcoin are durable. Gold is a physical metal that is resistant to corrosion, while Bitcoin, being digital, does not degrade over time. Gold has historically been seen as a reliable store of value due to its physical properties and long history as a form of currency. Bitcoin, although relatively new, offers durability in the digital realm, as it cannot be physically destroyed or degraded. This makes Bitcoin a modern, indestructible form of value storage that appeals to those looking to diversify their assets in the digital age. The durability of Bitcoin is backed by its blockchain technology, which ensures that its record of ownership and transactions is secure and cannot be altered or erased. Additionally, Bitcoin's decentralized nature ensures that there is no single point of failure, making it resilient against attacks or system failures. Portability. Bitcoin far surpasses gold in terms of portability. It can be transferred instantly across the internet. While physical gold is heavy and costly to transport, the portability of Bitcoin makes it particularly appealing in an increasingly globalized world where digital transactions are becoming the norm. Moving large quantities of gold across borders requires significant logistics, insurance, and security measures, whereas Bitcoin can be transferred anywhere in the world with just a few clicks. This characteristic is especially valuable for individuals looking to move wealth across countries, or for those living in areas with limited access to banking infrastructure. Bitcoin's portability also makes it a flexible asset for everyday use, allowing individuals to transact across borders without the typical constraints of traditional financial systems. For those who need to flee conflict zones or migrate for safety, Bitcoin offers a secure and portable way to take their wealth with them, unlike physical assets such as gold or real estate. Divisibility. Bitcoin is highly divisible, allowing for transactions in very small fractions, unlike gold, which is less practical to divide for smaller transactions. One Bitcoin can be divided into 100 million units, known as satoshis, making it easy to use in everyday transactions regardless of the amount involved. This level of divisibility makes Bitcoin accessible to a wider audience, as investors do not need to purchase an entire Bitcoin to get involved. Gold, on the other hand, is typically traded in larger quantities, which can be a barrier for smaller investors. The divisibility of Bitcoin also allows it to be used for microtransactions, which opens up opportunities for new business models in areas like online content and digital services. Bitcoin's divisibility also facilitates the adoption of micro-tipping and other forms of digital compensation, enabling new ways for creators and service providers to earn income from a global audience. Scarcity. Both assets are scarce. However, Bitcoin supply is predetermined and verifiable, while the amount of gold available can increase with new mining discoveries. Bitcoin scarcity is enforced by its code, which limits the total supply to 21 million coins, ensuring that no more can ever be created. This predictable supply makes Bitcoin an attractive option for those concerned about the erosion of purchasing power due to inflation. In contrast, the supply of gold is influenced by mining activities, which can fluctuate based on the discovery of new deposits and advancements in mining technology. Bitcoin scarcity is further emphasized by the halving events that occur approximately every 4 years, reducing the rate at which new Bitcoins are mined and making the asset increasingly scarce over time. This mechanism mirrors the deflationary aspect that many investors find appealing in gold, but applies it in a more transparent and predictable manner. The concept of absolute scarcity, combined with growing demand, has led many to view Bitcoin as a superior store of value compared to traditional assets like gold or real estate. Behavior in the financial market. Historically, gold has been a stable store of value, particularly during times of economic uncertainty. Gold is often viewed as a safe haven asset, which means that investors turn to it during periods of market volatility or geopolitical tension. Bitcoin, on the other hand, has exhibited greater volatility, with periods of rapid growth followed by significant downturns. This volatility has led to debates about whether Bitcoin can truly be considered a stable store of value. However, the growing institutional adoption of Bitcoin and the perception of it as a hedge against inflation have strengthened its position in the financial market. Institutions like Tesla, MicroStrategy, and various hedge funds have added Bitcoin to their portfolios, citing its potential as a hedge against currency devaluation and systemic risks. Despite its volatility, Bitcoin has shown an upward trend over the long term, with many investors viewing its price fluctuations as an opportunity rather than a deterrent. Bitcoin's volatility is partly due to its relatively small market size compared to traditional assets like gold, as well as its susceptibility to news and regulatory developments. As the market matures and more institutional capital flows into Bitcoin, it is expected that its volatility will decrease, making it a more stable store of value. The development of Bitcoin futures and exchange-traded funds (ETFs) has also contributed to its growing legitimacy in the eyes of investors, providing more avenues for institutional participation. The introduction of Bitcoin ETFs allows investors to gain exposure to Bitcoin without having to directly purchase or manage the underlying asset, further increasing its appeal to traditional investors. Bitcoin's behavior in the financial market is also influenced by its unique value proposition as a decentralized and censorship-resistant asset. During times of economic uncertainty, Bitcoin has been seen by some as a hedge against the traditional financial system, offering a way to protect wealth from government intervention and inflationary policies. While gold has traditionally served this role, Bitcoin's digital nature and programmability offer new possibilities for wealth preservation that were not available with traditional assets. The integration of Bitcoin into the broader financial ecosystem, including the development of custodial solutions and regulatory frameworks, further supports its role as a store of value. Bitcoin's use in decentralized finance, DeFi, protocols also provides additional utility, as it can be used as collateral for loans or to earn yield, making it a productive asset beyond its role as a store of value. Bitcoin's narrative as a store of value is further reinforced by its increasing adoption by corporations and governments. Some countries, such as El Salvador, have even adopted Bitcoin as legal tender, showcasing their belief in its potential as a reliable store of value. This type of adoption marks a significant shift in how Bitcoin is perceived on a global scale, and it could pave the way for further acceptance by other nations. The use of Bitcoin by individuals, businesses, and even governments highlights its growing role as a financial asset that can exist independently of the traditional banking system, offering a new avenue for preserving wealth in the digital age. Objective: this episode aims to understand Bitcoin's role in preserving value over the long term and its behavior in the financial market, providing a comparative perspective with gold and other traditional stores of value. By examining both the strengths and limitations of Bitcoin, viewers can gain a deeper understanding of its potential as an investment and its evolving role in the global economy. We also aim to highlight how Bitcoin's unique characteristics, such as its scarcity, portability, and programmability, contribute to its growing recognition as a viable store of value in the modern financial landscape. Disclaimer: this content is educational in nature and does not constitute investment advice.